McGrath, State Street's head of EMEA macro strategy. Good morning to you, Tim. Very nice to have you with us this morning, this Tuesday morning on the programme. Let me ask you about sentiment then for risk assets at this point. How bullish are you on global stocks? Sure. Given the backdrop, you know, a list of things to be concerned about, apparently, but we seem to climb that wall of worry and take stocks to new highs. So, how do you rate this recovery in global stocks we're seeing?
I think it's something of a bit of a relief rally. Yeah, as you mentioned, there were peak growth concerns. There were concerns that the Fed may respond a little bit more aggressively to the high inflation prints we've seen and the stronger labor market report we had last month. But at the end of the day, I think some of this is down to the fact that we're coming off an extremely strong quarter for earnings. And actually, that more importantly, the outlook still looks relatively constructive, particularly for IT, for industrials, for materials companies. You have infrastructure spending plans that are on the way. And so I think the reflationary outlook, certainly, we've had bits of pullback because you have had Delta variant spikes in cases in various countries. You've seen that delay policy normalization as we saw last week in New Zealand. And that always gives rise to some worries, as you mentioned. But the backdrop overall across the broader global economy is still relatively robust. And you have a policy framework globally that, outside of emerging markets, is overall very, very supportive for this type of reflation to continue, absent these hiccups we get every day.
So are you buying into those reopening trades, Tim? And if you are, does the full approval by the FDA of the Pfizer-BioNTech vaccine, does that give you even more reason to buy into those reopening trades? Because some are suggesting, whilst it might not seem material because so many people have had the vaccine already, the fact that we get official approval might give governments around the world a little more confidence to push for vaccine mandates, for example, and therefore add strength to that reopening impulse. How are you playing that?
I don't think it's certainly a negative. It's certainly not a negative in my mind. I do wonder if the hesitancy in taking the vaccine, from those who have access to it at least, if this probably isn't going to change the game too much for them. But the point you bring up about governments being much more comfortable with procurement and enforcing vaccination mandates of some stripe, it probably does help. I suspect, though, the recovery we're seeing is much more down to the factors I mentioned around earnings and the policy environment. But certainly, it's not a negative. That's for sure.
And European stocks, how do you expect the reopening trades to play out for European stocks? Because that cyclical push that could, a lot of people have looked to Europe, but to express that view, but maybe a lot of that has been done already. So where do you stand on European stocks with that reopening trade in mind, Tim?
Sure, there's a fair bit in the price, as you mentioned, but we still do like them because of the concentration, particularly of industrials within European indices, and the normalization that you'll tend to see eventually through interest rates and the high concentration of financials within European indices and the value in financials as well leaves them more attractive. But it really it's that cyclical component that still appeals to us where we don't think that's fully priced. We do suspect the earnings outlook for a lot of these European corporates and the investment outlook in particular with a lot of these cash-rich corporates in Europe is still very constructive for the medium to long term. So Europe is a region we still definitely do like.
So, Tim, if you're quite positive about cash-rich corporates in Europe, about profitability in Europe, where do you look for warning signs, if you like? I mean, I was looking at one this morning. This maybe is more US related, but still I wondered if it registers on your radar. Is there a warning in credit markets? One of my colleagues was asking. US high-yield bonds, we've seen spreads widening for the seventh week in a row. They're still tight versus history, of course, but there is a sense that perhaps some people are worrying more about corporates from that perspective. What are the worries that you keep a close eye on?
Yeah, I don't think corporate credit yet is the issue. I mean, it always is the case that complacency and stability breeds instability, the old Minsky model of thinking about things. But looking at corporate balance sheets, the ability to fund current debt is not that impaired, and I don't think we've seen exuberance on the level we've seen yet in past credit blow-up cycles. And so I wouldn't necessarily look there. I think the worry for us, and one where we've had to adjust thinking, is the notion of crackdowns on corporates in emerging markets, particularly in China. We've had to neutralize views in EM Asia as a consequence of that, because it's not to say that the environment is so unhealthy were these concerns not there. We still like corporate IT and tech. but it's that unknown, and it's the inability to really see the future. Not that we have the ability to see the future in the best of times, but it's that uncertainty that you layer onto it compared to, say, developed market IT, where you don't have those concerns. That's a warning sign for me, as well as COVID. I mean, COVID is still going to affect emerging markets in particular in ways we don't quite understand yet, and so that's something we always have to keep our eye on.
Okay, an inability to see the future in Chinese tech. We'll certainly pick up on that conversation next then, Tim. Thank you.